Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. The Fed spoke today and the market reacted. It sunk when the press release came out, and then it sparked a rally when the Fed chair, Jerome Powell, came out and gave his 2 cents about the market. There were some key items that I want to talk about today that the Fed talked about. And looking at the chart here, we nailed it, absolutely nailed it perfectly on the chart. Look at this, guys. Look at this. We have had the same chart up here on the S&P 500 now for weeks now. And we've had this resistance line drawn, right? It tried to break through here on February the 9th, right? It closed slightly above it, but the next day we had 3 days in a row of a sell-off, right? And then here on March the 3rd, it tried to break through that, but it just couldn't, right? And it fell. Today, guys, right on the 16th, right on the FOMC meeting, when the Fed came out, when the Fed raked the hikes, right? Up 25 basis points. Here we are with a rally into the close. The S&P up 2.24% right here, breaking above this resistance line, following our green arrow. Now, we talked about this yesterday about the death cross that occurred right here in this circle, this red circle here. A death cross on the S&P 500 occurred right here on March the 14th, okay? We have this death cross. I talked about this yesterday. When you have a death cross like this, in recent history, going back several years, every time there has been a snapback rally, and the snapback rally has gone all the way up to where the crossover event happens. So I have got this purple line drawn right here, right around 4470 for the S&P 500. This is where I believe the S&P 500 is going, because this is exactly the point at which the crossover event for the death cross occurred. And the past 5 or so death crosses that we have had, they've been followed by a snapback rally to the crossover point. So this is what I'm looking for in the short term. The S&P to rally to 4470. Very important numbers. Write them down. Keep an eye on it and watch for that. I'm not saying it's going to be green all the way until we get to that point. We can have some red days in between now and then, whenever it occurs. But it has occurred, a snapback rally. It usually takes a few days, maybe as long as a few weeks, 2 or 3 weeks, to get to that point. So that's what we're looking for in the short term from the S&P 500. The snapback rally that takes us all the way to 4470 for the S&P 500. And yesterday and today, right after that death cross occurred, we have had 2 very strong, powerful rallies. Yesterday's rally was 2.14%, and then today 2.24%. Can we get a couple more? We're about 5% or so, and let's see where we are today. From close today up to this purple line, which is 4470, 4470, we're about 2.6% away. So if we have one more strong day on the S&P 500, stronger than today, 2.6% rally, and we're at that point on the chart already. And when the death cross occurred, let's go back here and look on the chart. This was on the 14th. The S&P 500 was 4161. That's the low for that day, and it closed at 4173. So we are basically going from 4173 in this snapback rally from the death cross, 4173, let's get as close as I can, up to this purple line, 4470 on the S&P 500, 4470, get as close as I can, That is about a 7.2% rally in the S&P 500, and that would be incredible. As we stand right now, the S&P 500 is still down 9.1% year to date. So my goal, my projection for the end of this year is for the S&P 500 to be up about 8% on the year. So that means the rest of this year, it's going to be very volatile like it has been so far. But maybe we can get back to that 0 point, right? The break even point for the year, and then maybe just bounce around that for the rest of the year and avoid these big sell-offs like we've had here. But uh, the death cross has been a buying opportunity for the past several death crosses that have occurred. So I did put a standalone video out today. It was uploaded this morning about the death cross. I went into a little more detail than I did yesterday during the live stream about the death cross, showing you the evidence and to support what I'm putting out there from what the S&P 500 has done historically, showing you on the charts those different time periods and the snapback and what it looked like. So check out that video if you haven't already. It's about the death cross and the S&P 500. Real good information. Also, if we look, 2 powerful days, yesterday and today in the market. If we look at the relative strength index, the RSI, it is only at a 45.8. So this market right now is nowhere oversold, or I mean overbought. It's nowhere overbought because the market was so oversold, right? We had some pretty deep lows. And if I bring the chart up a little bit tighter, we can see the biggest low occurred with the biggest rally on February the 24th. And that's when the S&P hit a low of 41.14. And we've been watching that 41.20 area really closely because there were a couple times we got kind of close. 41.61 and 41.57 were the two closest. But yeah, watch for this thing to snap back to 44.70 on the S&P 500. Very remarkable. And boy, did we hit this nearly too perfectly. Nearly too perfectly. All right, so the S&P 500, it closed up today 2.24%. As the market seemed to brush off the hawkish sounding FOMC decision once Fed Chair Powell started speaking. Now, the Nasdaq it rose 3.8%, incredible day. The Russell 2000 was up 3.1%, and the Dow Jones increased 1.6%. So a good day across the board. 8 of the 11 S&P 500 sectors did close higher today. Consumer discretionary up 3.4%, information technology up 3.3%. Energy, though, it was down 0.4%, and utilities were also down 0.2%. Those were the two sectors that closed the lowest. Now, prior to the Fed, the session started with a risk-on mindset, bolstered by huge gains, and I mean huge gains, in Chinese markets after Beijing vowed support for the economy and financial markets. And reports indicated that Russia and Ukraine continue to make progress in peace talks. We'll see how that translates in the real world. Now, the market continued to favor the idea of a ceasefire, even as Ukraine rejected a neutrality plan proposed by Russia. Now, regarding the Fed, the central bank raised its target range for the Fed funds rate by 25 basis points to 0.25% to 0.5%. That's the range we are in right now. No longer 0 to 25, or I mean 0 to 0.25. We are now up 25 basis points to 0.25 to 0.5. Okay. There's always a quarter spread on the rates there. Now, the Fed did signal about 6 more rate hikes this year, with 4 additional hikes next year in 2023. Now, the statement noted that the Fed would begin reducing its balance sheet at an upcoming meeting in the future, possibly in May, according to Jerome Powell. Now, projections for interest rates were a bit more hawkish than anticipated, stoking some concerns about a policy mistake that could hinder economic growth. That is a possibility. Now, that view, it was telegraphed in the Treasury market today as well, as the yield curve flattened via a sharper rise in shorter dated rates. Now, the Fed, as usual, produced a lot of volatility in the market today. Fed Chair Jerome Powell, he soothed the markets with one of his very first statements right out the gate, and that statement being that he thinks the probability of the R word, recession, within the next year is low. Now, whether you believe that statement or not, that's what he said. He added that the reduced 2022 GDP growth, the forecast of 2.8%, well, it's not because the economy is slowing. It's all tied to Russia's invasion of Ukraine instead of an expected impact that the Fed's tightening actions are making. Now, there is an argument to be made against that. I know the situation in Ukraine is providing uncertainty and fear in the market. It's a wild card. It's the wild card in the market. With the Fed today, we got a lot of certainty, and the market loves to have a crystal ball and know what's going to happen next. Well, we got a bit of a roadmap today with the Fed, a little one. Jerome Powell did a lot of answering questions when they were asked to him today. So there's that. But the economy is slowing. We saw it in the retail report today. The economy is slowing. Consumers are purchasing less items. In the retail report today, it was down below expectations. And it shows that consumers are purchasing less items. And that's all due to inflation, gas prices, everything going up, everything becoming more expensive. So your dollar doesn't go as far as it did a year ago. So consumers, they may be spending the same amount of money ish, but they're buying less items for that money. So I don't know about the speak about it's Russia's fault the economy isn't doing so good. I think the economy is not doing so good because the Fed was behind the curve on inflation. So, just something to think about. There's always an argument to both sides of the coin, and trying to decipher which one is correct, it can be difficult sometimes. So that's why we have to be open minded and realists. Okay. We can't be pessimistic about the market. We can't be too optimistic about the market. We must be realists. We must understand what is really happening and going on. All right. Mr. Powell also acknowledged that monetary policy could weigh on inflation and growth rates in 2023 and into 2024. I thought that was interesting. Now, I am a firm believer in the camp that inflation is slowing the economy. It's contracting the economy. Sure, the wild card that we have with Ukraine and what Russia's doing, it's a wild card, right? It is causing problems. But this growth rate slowing down, the Fed is trying to wash their hands of any responsibility. That's what I see today. Okay. We also got like I said, the retail sales report today, and it wasn't as disappointing as the headline numbers suggest because it showed that total retail sales increased 0.3%. The expectation was 0.4%. So slightly below, but still below, right? but not as bad as you might think. Now, the key takeaway from the report is that there was a natural slowdown after a huge sales month in January. However, gasoline station sales were up 5.3%, and there was a difference, or that was the difference uh, in the market for February. Now, if you exclude gasoline stations, retail sales declined 0.2% month over month, right? Providing a sign that things to come, perhaps as gas prices move higher in March, are going to be slowing quicker. Okay. March will probably be a bad report, and we don't get it until April. So just keep that in mind. And this is why I believe moving forward, I think we'll hit our target here for the S&P 500 with the snapback rally. But the rest of the year, it's going to be just as volatile as the year has been already because companies' growth is slowing. The economy's growth is slowing. Earnings reports aren't going to be looking so good, especially when they're lapping really big comparisons from a year ago, right? Whenever you have a company that grew 50% in, let's say, one quarter, and then a year later, they only grow by 2%, you're going to say, oh, wow, their growth has slowed down tremendously. 48-point difference there. 48 points of slowing growth. So it doesn't look as good, even though they did grow by 2%. So they might have done, let's say they did $50,000, just simple numbers, 50 million, whatever it is, doesn't matter. They did 50 million, right? And then in the following year, they did 52 million. Well, just simple terms, I'm not calculating math here. Let's just say they grew by 2%, right? And that was the $2 million. So they went from 50 million a year ago to 52 million this year. So the growth was 50% when they did 50 million, and then the following year it was 2% growth when they did 52 million. They still did that 50 million from a year ago and then added 2 million onto the top of that. So they were still growing. It just doesn't look as though they were growing as much because their growth slowed down. They weren't growing at 50% anymore. That's what we're going to see in earnings reports this year. The second half of this year are going to look rough. And that's going to cause the market to sway back and forth, up and down. The other thing to point out is that then in the following year, right? The first year they grew by 50%, the second year by 2%. So they were lapping this 50% comparison from the year ago. But then next year, the following year, the third year, they may grow by 5%, but they were only lapping or comparing to growth of 2% the previous year. I hope I'm not confusing you out there. I wish I could write this down on a little pad here, like Meet Kevin does. You know how he writes it out? So it's much more easily uh, to visualize this information than just sit back and hear it. And I just don't have a way to visualize it right now. But if more of you join us to help support our work and beat this market with us by clicking the first link in the description, then we can get to that point where we have the technology in order to do that with your help, of course. We're doing this for you, and if you could help us, that would be great. And that's one of the goals that we'd be going for. So we can have better visualizations for you guys at on the other end of this camera. Okay, let's go on to another metric that came out today, the weekly MBA mortgage application index. It declined 1.2% this week. Mortgage applications declined 1.2% this week. It increased by 8.5% last week. So for some reason, last week seems to be an anomaly, right? Because out of the past 4 that we have gotten, only last week were there gains. We've been losing ground on mortgage applications. Less people have been buying homes. Now, my theory is there's a group of people, especially first-time home buyers, who are getting priced out of the market. And as interest rates continue to rise, that group of people are going to continue to get priced further and further and further out of the market. Another way to think of it is an options contract when you're in the money versus out of the money, right? So, this slowdown in mortgage applications, it can be a precursor to maybe a housing market that's slowing down, right? But it can also, on the flip side of that coin, it can show that the housing market is screaming and blowing up faster and at a faster rate because it's causing people to be priced out of the market. Therefore, they aren't signing up and getting mortgages. So there's two sides, again, to everything out there. There's an argument for and against everything out there. I'm in the camp here for the housing market that the housing prices, I believe, are going to continue to rise. Interest rates are going to continue to rise. I don't believe house prices are going to continue to rise at the rates they've been rising over the past 2 years. I believe that growth in real estate value is going to slow down, but I believe it's still going to go up because we continue to have a shortage of housing. We have plenty of demand for housing. We just don't have enough houses for everyone looking to buy a home. As many of you know, I'm in that camp, ready to buy a home. But due to the wheelchair, there's certain homes that don't work, right? Uh, a 2-story home makes things a little more difficult, but you do have the power chair that can go up a flight of stairs, so not completely out of the ballpark. Just makes things a little more difficult, but it's still doable. So the housing market, the markets that have shot up the most, right? You can find that in Florida. You can find that in Texas. You can find that in certain states out west. Those areas are going to be the areas that will be hurt the most. We'll see the sharpest decline in housing prices. And the reason for that is because of how fast the cost of owning a home rose in those areas over the past 2 years. And then you compare that to what the median household income is. And in some states, it's almost equal. And you can't afford housing when it is near 100% of your pay. It's just not impossible. You also have to eat, pay for energy, water, fluids, right? So those are the markets to be careful in. The ones that have seen the biggest housing cost increases. So there's that with the mortgage applications this week, and a little rant there on uh, the housing market. All right, tomorrow, investors will receive, again, in the housing market, we're going to get housing starts and we're going to get building permits for the month of February tomorrow. Okay. That data is going to contribute to the housing market theory, right, or hypothesis as well. Housing starts are construction that has already began on a home. Building permits are permits that have been granted for new homes to get built. So, permits not built yet and have not started building yet, but they have the paper that says they can start building. And then housing starts, obviously, is construction on the home has begun. So we're going to get those two numbers tomorrow. It'll be interesting to see if they are up or down. They need to be up because we have a lack of housing in America, and it's a problem, and it's becoming a bigger problem. So that's information that we will get tomorrow. All right, here's where we stand year to date. The Dow and this year to date one, it makes me feel a lot better saying. I didn't like saying it when the Nasdaq was in a technical bear market. It is now out of the bear market. It was out of the bear market yesterday, but it is still in correction territory. So the Dow Jones is in first place. It is down 6.3% year to date. The S&P 500 is down 8.6% year to date. The Russell 2000 is out of correction territory, down 9.6% year to date. And the Nasdaq, well, it's still in correction territory, but out of a bear market. And again, correction territory is down 10% from your high. A bear market is down 20% from your high. The technical terms, that is. NASDAQ down 14.1% year to date. Sounds a whole lot better saying that than 20 some percent, right? All right, let's check in on BTC USD on TradingView. And there is a link in the description for a free account to TradingView. And we talked about Bitcoin making its reversal already. And I didn't click on the right icon here for Bitcoin. I need Coinbase. Where are my drawings? There they are. There we go. All right, I'm going to take volume out of here for just a moment so we can see this a little clearer. All right, so Bitcoin is in an uptrend. It has broken its downtrend. It did that back here on January the 27th. Bitcoin reversed. That was the first day. And Bitcoin is now in an uptrend. And I can now extend these lines out a little further. And I'm going to go ahead and push them out here a little bit further because you're going to start to see something become a little more clearer. So I want to make sure I keep these lined up right. There we go. And along the top, I'm going to do the same thing. I'm going to bring it out to the same point and then keep it lined up appropriately. And there. So here's where Bitcoin is moving. it's moving to this area here, and I'm going to do this from there straight down to there, and then just open that up a bit. Okay, this is where Bitcoin is going, right? And you can see that if I were to have made an oval back here, this mouth is a lot wider. From this top here to the bottom over here, that's a spread of 25.6%. Okay? 25.6% is the spread here at the opening. This is a wedge pattern. So 25.5%. But now, as we get over here to our target, it's no longer 25.5%. It's now 12.6%. So that shows you we're in a wedge pattern and we have a converging of the two trend lines. We have a converging between the bottom trend line and the top trend line. Now, this could go on for a longer while, even past this target. But this is where I'm shooting for Bitcoin to go. As time moves forward, I expect Bitcoin to, do its thing, rising and falling, and eventually go right through this hole right here and enter a new dimension. Enter a new dimension when it passes through here. But this is where I see Bitcoin heading in the short term. And this is set to the end of March, so March 31st. And then the very next day after it crosses the center of this would be April the 1st. So that's where I see Bitcoin going. So that means Bitcoin shouldn't get any lower than where this bottom trend line is. And on the top side, it shouldn't get any higher than where this top trend line is. Now, there is one thing to point out, though, with this setup here that I'm looking for with Bitcoin. And that is that if we look at the blue line underneath the candle and the blue line on top of the candle, in between is the Bollinger Band, okay? That's this blue line that looks like a small intestine or large intestine, right? That is following the price action of Bitcoin. And what it's showing you is where the bottoms and tops could be, right? So for Bitcoin, the Bollinger Band is actually down here below this support trend line that I have drawn, okay? So technically, Bitcoin could get that low. Right now, that point is 36,010. That's where it sits at the moment on the bottom side. Up top, it sits at 44,061. Yeah, 41,061. 44,061. Make sure I'm saying that right. And then there's actually another line here that is right in the, seems like it's in the middle of these bands. This right here is a short-term trend line. Okay. We've got a few trend lines on the chart here. We've got our 20-day, our 50-day, and our 200-day trend lines. So this darker line that's running like in between, right in the middle of the Bollinger Band, that's the 21-day or 20-day moving average. And then we've got a lighter blue, like an aqua blue, running through here. Right now, it is sitting almost where the 21-day moving average is. If I come in here a little bit tighter, that it's sitting right above it right now. So Bitcoin is above its 50-day moving average and its 21-day moving average, which is a bullish sign. It's a bullish signal. So right now, the 21-day moving average is 40,034. The 50-day moving average is 40,179. And then we've got the orange line up here at the top of your screen. That's the 200-day moving average. And right now, that's at 48,614. All right, so here we go for Bitcoin. Here's my target right here. This red circle filled in with yellow. That's our target for Bitcoin. Now let's go look at Ethereum and put a target on Ethereum. ETH USD, and I use Coinbase as the source of data for looking at this. Now we've got the same exact bands on here and trend lines as well. Now Ethereum's its trend line is already moving at a tighter pace. Okay, when I bring these lines out, these trend lines out further, they're not leaving much room to wiggle because they're starting to get tighter. So if I put a line on here, just like so, open that up a little, you can see that circle is a lot smaller than Bitcoin right now. And that means that price action is getting tighter or compressed on Ethereum right now. And usually, when you have these wedge patterns and the price is starting to get tighter and tighter and tighter, once it reaches its nexus point, it is going to do one of two things. It's going to shoot up, right? And it will go up to the top of this point here, which for Ethereum would be right around 32.48. Or sometimes it can break down and go down, and it would go at least to 21.47. I have a feeling we're going to come out of this nexus point right here, and we're going to shoot up and up, and we're going to test this area at 32.55 to 31.75. That area in there, we're going to test that area when Ethereum breaks out of its nexus point here, I like to call it. All right, so there's Bitcoin, Ethereum, and the market today, what the Fed said, what the Fed's doing, and a couple points there on it. So remember, this live stream is for you. So if you do have a question, leave the ticker symbol and your question in the comments. We'll go over it live during the show. That's the whole reason why the live stream is even up every day. It's here as a way to answer your questions, and we just talk about interesting things and in between, right? In between your questions. So that's all I wanted to cover for today's live stream. And make sure you check out that Death Cross video that came out today. It gives you a very good insight to the S&P 500, the Death Cross, and what it means and what you should do right now to prepare for the aftermath of the Death Cross since it has occurred. And going back in history, the past several years, going back pre-pandemic, everything looks pretty bullish. But we do have one wild card that I do talk about in the video, so make sure you check that out. This Ticker Time News, Death Cross, or just go to our page. I'll put a link in the description of this video that'll take you directly to the video. So I'll put that in here. All right, ladies and gentlemen, thank you very much for joining me today, and I'll see you in the next video.